Learning objective 8.4, account for accrued liabilities and unearned revenue. Accrual accounting requires expenses be recognized as they are incurred and matched against revenues earned in the same period. Liabilities associated with these expenses are accrued liabilities. So some examples would be sales tax and commissions are examples of accrued liabilities that are incurred at the point of sale and recognized in the same period the sales are made. Salaries and rent are examples of accrued liabilities that are recognized at the end of the period as an adjustment to the financial statements. So let's discuss sales tax payable, payroll liabilities, and accrued warranties payable. First thing, sales tax payable. Suppose a Home Depot store's daily sales total $200,000 and an additional 5% of $10,000 of sales tax. Let's assume this is all in cash. The store would record the following day's sales as follows. So cash, well, they sold $200,000, but they're going to add on to that 5%. To make that happen easily, we can take cash of $200,000 and multiply it by 1.05. Now you might ask, well, why the 1? Well, 200,000 times 1 by itself is 200,000. So you're saying, no, I don't want just the 200,000. I don't want just the 1. I want it with an additional 0.05. So 200,000 times 1.05 would give you 105%, and that's going to give you $210,000. Sales revenue will be the 200,000, and the additional sales tax is the 5%. 5% times 200,000 is the 10,000. Debit, credit. This is to record the sales and related sales tax. The way this is going to work on T accounts, we're going to debit $210,000 in cash. We're going to credit sales for $200,000. And we're going to credit sales tax payable for $10,000. So even though we collected the $10,000 over and above the sales, that $10,000 really isn't ours. We're going to have to recognize it as a liability so that we can pay it out to our government officials. In this case, would be it used to be the State Board of Equalization. That name has changed. I can't remember. I'm getting too old to remember those things. All right, in addition to sales tax, we may have payroll liabilities as well. Whenever we process payroll, there's going to be some payroll taxes that are going to be associated with the payroll wages. Payroll, also called employee compensation, is a major operating expense. For service organizations, payroll is the major operating expenses. Well, that is true. None of my expenses come close to what I pay out in payroll. So, employee compensation takes many forms. It comes in salaries, wages, commissions, and bonuses. So let's take a look at an example here. Accounting for all forms of compensation following the pattern illustrated below. So it appears that we have in this payroll one, we have a situation where we are paying our employees $10,000. Unfortunately for the employee, they're not going to get all $10,000. There's going to be some taxes that the employee has to pay. So the employer is going to be required to withhold some money. We're going to withhold employee income tax payable. This will be both federal and state. In the state of California, we have both federal and state. In this example here, it's $1,200. We have FICA tax payable, which includes both Social Security and Medicare. And if that's the only thing we have, then we have whatever, after we make those deductions, that's what we have left to pay the employees. And that balance is due $8,000. So $10,000 is the expense for the wages. $1,200 is due for employee income tax payable. $800 is due for FICA tax payable. and then the $8,000 is due to the employee. The way this will look on a T account. Okay, so in our example here, we have $10,000 that's debited to salary expense, $1,200 that's being withheld for income tax payable. We have $800 that's being withheld for FICA tax payable. And what we know that we owe the employee is $8,000. So we see $10,000 reduces equity because we have an expense, and we have an increase of $10,000 in liabilities, although broken down into wages payable, employee income tax payable, and FICA tax payable. For FICA, the computation is 6.2 plus 1.45, 7.65% of the total gross revenue, and then salaries payable. The next item discusses accrued warranties payable. Warranties guarantee a company will repair, replace, or provide a refund for a product that is found to be defective within a certain period of time. Warranty expense must be recorded the same period the business records the product sales or revenue. So you sell something, you know that some of it is going to come back. You have to estimate what that expense is going to be. So businesses, the last bullet, businesses must estimate the warranty expense and the related accrued liability. Let's go on to the example here. Suppose Black & Decker made sales of $100,000 subject to product warranties. Assume that in the past years between 2 and 4% of products were defective. Black & Decker could estimate that 3% of sales will require replacement of the items. Black & Decker would estimate its warranty expense to be $3,000, which is $100,000 multiplied by the 0.03 for the year, and make the following journal entries. So they sold $100,000. Because in the past it's been between 2 and 4%, they're going to go ahead and use 3%. And 3% times 100,000, that's what was sold, ends up being $3,000. So they're going to record warranty expense of $3,000, a debit, and a credit to accrued warranties payable. Okay, so I follow along with the journal entry. The debit is to warranty expense for $3,000, and the credit is to accrued warranties payable for $3,000. Now let's suppose the defects add up to only $2,800. Black & Decker will replace the defective products and then record the following entry. They're going to debit accrued warranties payable for $2,800 and credit inventory. So we're going to debit $2,800 toward accrued warranties payable, and we're going to credit inventory for $2,800. And what this is going to do is this entry is going to represent the inventory we're taking out in order to replace the defective inventory that's been returned. That defective inventory, we're likely just going to throw it away, so there's no value there. It's just going to go away. The warranty requires us to replace defective materials, warranties, so we just simply credit the inventory to replace it. And finally, we'll discuss unearned revenues. This is also called deferred revenue or revenues collected in advance. Cash amounts a business receives from customers before earning the revenue, or prepayments by customers for goods or services. In the example we've discussed before, we may have a company who prepays something in advance, and so when he or she does that, then that company has an asset. Well, that's the company that paid in advance. I'm talking about the other side of the equation. We're talking about the company that receives cash in advance. Before they provide the product or service, they receive the cash for whatever reason, maybe because the company wants to use it for tax purposes, or they want to ensure that they get this product, so they go ahead and send the money first before you even have it ready. When the cash is collected, the company incurs a liability, an obligation to provide goods or services in the future. So let's take a look at an example here. Suppose that on June 30th, 2018, Amazon.com collected $3 million for one-year memberships to Amazon Prime. The company records the cash collection and related liability as follows. So on June 30th, they're going to recognize the cash, $3 million is debited, and they're going to create a short-term or current liability referred to as unearned revenue, and they're going to credit that for $3 million. So they're going to take in $3 million. That's going to be a debit to cash and a credit to unearned revenues. That is a current liability, but clearly it's a liability. Okay, so then on December 31st, they took this in, when did they take it in? On June 30th. So 6 months ago, they took the money in. Let's see, it was for one-year membership. It probably started July 1st. The membership started July 1st. So now we're at December 31st. Well, some of this has actually been earned. If the membership is for 1 year, then the membership starts on July 1st and goes all the way to June 30th of the following year. But now our fiscal year end is December 31st. We have to make an adjustment. And that adjustment is recognizing some of the revenue that was previously recognized as unearned is now earned. So it looks like half of it is now going to be earned. That journal entry to recognize would be a debit to unearned revenue for $1,500,000. That's half of it. And then there's going to be a credit to service revenue. And the way that's going to work is we're going to debit $1,500,000 towards unearned revenue. That's the debit. And we're going to credit sales for $1,500,000. So even though they received the cash on 6/30, they won't recognize the revenue until they've earned it, which is on 12/31. But even at that, then they haven't earned all of it because it's for a full year subscription. They've only earned 6 months. So therefore, they are showing $1,500,000 of income or sales for that fiscal year.